Let us see the next question. Two companies, ABC Ltd and XYZ Ltd, approach DEF Bank for forward rate agreement. They want to borrow a sum of 100 crore after 2 years for a period of 1 year. Bank has calculated yield curve of both the companies as follows. Yield curve, in a simple language, it is the spot rate. 1 year spot rate, 2 year spot rate and 3 year spot rates have been given for XYZ and for ABC. For ABC we can see that consistent rate is more. They have given explanation over here. The difference in the yield curve is due to the lower credit rating of ABC compared to XYZ. So they have given only an explanation that why the spot rates are different. You are required to calculate the rate of interest DEF Bank would quote under 2 into 3. 2V stands for 2 into 3 forward rate agreement using company's yield information as quoted above. Means if at all XYZ wants to borrow for 1 year, directly for 2 years and directly for 3 years. For these three, the rate of interest have been provided to us. So now we have to use this information for the purpose of making calculation of the forward rate. So let us answer the question. Calculation of F3. What do we understand the term F3? Forward rate for third year. This is what we are required to calculate. Let us see how to make the calculation for XYZ first of all. It will be calculated like this. One plus spot for the second year raised to 2 into 1 plus F3 is equal to 1 plus spot for the third year raised to 3. This is the way the third year forward rate will be found. For XYZ, the second year spot rate is 4.20%. So 1.042 raised to 2. And spot rate for the third year is 4.48%. So F3 will be found as balancing figure. So 1 plus F3 is equal to 1.0448 raised to 3 upon 1.042 raised to 2. So now F3 will be calculated as balancing figure. So it will be found like this: 1.042 1.0448 raised to 3. So F3 is 1.0504 minus 1, 0.0504, that is 5.04%. This is the way F3 is calculated. Now whatever we have done for XYZ, similarly we will do for ABC. It will be 1 plus spot for the second year raised to 2 into 1 plus F3 is equal to 1 plus spot for the third year raised to 3. So 1 plus F3 is equal to, for ABC the third year spot rate is 5.78%. So 1.0578 raised to 3 divided by 1.0548 raised to 2. So now F3 is equal to 1.0578 raised to 3 upon 1.0548 raised to 2. Whatever the answer that we have, from that 1 would be deducted. So it is 6.38%. 0.0638, that is 6.38%. This is the way we make the calculation of answer. So we understand it. So this is the way the forward rate is provided to each of the company by the bank. Suppose bank offers, here there is a new concept, interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate interest payable by XYZ Ltd if interest rate in 2 years turns out to be 4.5% and 5.5%. That is the question. Please go through the question, and the important point which I want to tell you is that the second part of the question is important, because of which we are doing this in the classroom. Let us have understanding of this new concept. Information is provided to us regarding the rate of interest after 2 years. In the first question it has been given 4.5%, and in the second question it has been given 5.5%. Now basically the question is about the XYZ Ltd. And we understand that as far as XYZ Ltd is concerned, we have provided the forward rate to them as 5.04%. So I am writing over here, forward rate of interest is 5.04%. Now understand carefully what I am going to speak. The question is providing the information about the interest rate guarantee for a premium of 0.1%. So what happens, I'd say first of all you are required to make the payment of premium. We have been provided that say the loan amount is 100 crore and the amount of the premium is 0.1%. 100 into 0.1%. So that comes to an amount of 10 lakhs. So 10 lakhs is required to be paid in form of premium. Now why do you pay premium? By making payment of premium, you have a right to borrow at 5.04% and you are not obligated to borrow at 5.04%. So what happens, let's say when the market rate of interest is lower than the forward rate of interest, then in that case you will not borrow as per the forward rate agreement. What happens, let's say you will borrow at the rate of 4.5%. So as far as the interest cost is concerned, it will be 100 crore into 4.5%. So 100 crore into 4.5%. That comes to 450 lakhs. This is the way the total cost will be 460 lakhs. And we can say that the effective rate will be 4.6%. This is what we understand. And when the market rate of interest is 5.5%, then you will borrow as per the forward rate agreement, and your cost of the borrowing would be 100 crore into 5.04%. So the amount of the interest is going to be 504 lakhs. And the total cost is 514 lakhs. So in that case it is 5.14%. This is the way we will have the effective cost. So over here, language of the question speaks that suppose the bank offers an interest rate guarantee for a premium of 0.1%. You are required to calculate interest payable by XYZ Ltd. if the interest rate is this. So basically the interest payable by the company in the first case could be 450 lakhs and in the second case 504 lakhs, and of course this amount is excluding the premium because the premium is required to be paid unconditionally and that is required to be paid separately. Please write an answer. So please write an answer.